Buongiorno, io sono Stefano Lepri, editorialista.
Good morning. My name is Stefano Lepri from La Stampa, and today I have the pleasure of introducing our speaker. Usually I don't make compliments, but I can say for sure that Barry Eichengreen is certainly one of the greatest experts of currency worldwide, and I have learned that as a journalist. I'm really happy that there's a large audience today. Barry Eichengreen teaches at Berkeley University in California, is the author of many books. One of these has not been translated in Italian as yet, but you can find a copy outside. It's called Exorbitant Privilege. It's a book on the future of currencies, the future of dollar. But I think he is the greatest expert of euro in the United States. And understanding each other from the two sides of the ocean is not easy. As a professional journalist, I realize that even the best American economists very often are not really full experts of how the euro works. And I think he's going to talk about that too today. He will briefly describe the main problems that currencies have now worldwide. He's really an expert, but he also is an expert of many other things, and he can put all this information together very effectively. Americans tend to be highly specialized on a particular field, whereas Mr. Eichengreen is an expert of many. So he can talk about the problem of currencies in the context of our crisis and in the context of economic history. And he is also an expert of Italian economic history, was one of the speakers at the conference organized last year by Banca d'Italia on the history of Italian economy on the 150th anniversary of unification. And with two Italian economists, they delivered a presentation on the history of the lira exchange rate and its impact on our economy. But there's another reason why I'm very happy to have Barry Eichengreen here today, and that is that his family has deep roots in Europe. His mother, Lucille, and by the way, I also brought here another book on it. His mother wrote some books on her experience after being brought to Bergen-Belsen and Auschwitz. It's the history of women in extermination camps. It's the third book, actually, written by Lucille Eichengreen, reporting this dreadful experience of her. Now, I don't want to take more of your time and give the floor directly to Mr. Eichengreen. Thank you.
Stefano, thank you for that that very nice and also touching introduction. You should have mentioned perhaps that my mother's book is translated into Italian. You described a number of the reasons why I am not so widely respected in the United States among economists. I'm inadequately specialized. I do historical work, and which is somewhat unfashionable among economists in the United States. And I'm a believer in the European project. I continue to think that the euro will survive, which is very much a minority opinion in the U.S., but we will return to that. It is really a pleasure for an economist. It's a kind of a unique experience to be in Trento for the Festival of Economics. A number of my Berkeley colleagues, from George Akerlof to Gerard Rollin, have told me about what a nice experience they had here. My talk inevitably is somewhat different than many of the others at the festival. I will be talking about currencies and their use across the generations, and how the situation facing future generations will be different from that facing current ones. and I will be talking about international currencies in particular. So when I say international currencies, people in this room will undoubtedly think about this one. This is a currency that is used in what at latest count is it 17 or 18 European countries, but they would be wrong. The right currency to think about in the international context is, of course, this one. So the first point that I want to emphasize is the remarkable extent to which our 21st century global economy still is dollar-based. It still depends to a striking extent on the dollar to finance international transactions of all kinds. So let me give you a couple of statistical reminders of that fact, of the extent to which we still live in not only people like me in the United States, but all of us still live in a dollar-based world. The dollar is still involved in 85% of all foreign exchange transactions worldwide. This according to the latest triannual survey conducted by the Central Bankers Bank, the Bank for International Settlements. The dollar still accounts for fully 60% of all of the foreign currency reserves held by central banks and governments around the world. Its use in invoicing and financing trade-related, commodity trade transactions far exceeds countries' trade with the United States. The dollar still accounts for nearly half of all international debt securities issued and traded worldwide, and it's the dominant funding currency. In other words, it's the unit that commercial banks, even in Europe, borrow when they want to finance, when they want to fund investments of all kinds. So, what really do I mean analytically when I'm talking about international currency status? The previous statistics have already implicitly given you the answer. I'm talking about a currency that's widely used to settle trade-related transactions. It's widely used as a vehicle or a currency of denomination for private international investment, and it's widely held as reserves by central banks and governments. So there is a conventional wisdom about why the dollar remains so dominant even today at a point in time when the United States accounts for less than a quarter of the world economy. Number one, the dollar has incumbency on its side. Inertia in the use of international currencies is strong, in other words. Element two of this conventional wisdom is there is room in the world economy for only one true international currency, just like there's room in the market for consumer electronics for only one dominant operating system, or so it was long said. You can begin to anticipate where I'm heading. Put these two observations together, and they suggest that the dollar will remain the dominant international currency for future generations, like it is for the current one. So what I want to do by way of starting is to challenge that conventional wisdom. Number one, to use some historical evidence to show that inertia in the international use of currencies is not, in fact, that strong. The situation has and can change very quickly. I will use some historical evidence to show that the natural monopoly argument, that there is room in the global market for only one true dominant international currency, is similarly rejected by the historical evidence that multiple international currencies have in fact coexisted at a point in time, and that this has occurred rather frequently. Put these observations together, and one can suggest, I will suggest, that future generations will have a choice of international currencies, that multiple international currencies will coexist, and I will leave the punchline, which global currencies, for the second half of the talk, if you will. So what is the conventional historical wisdom? People who write about this subject tend to invoke the relevant history, invoke economic history without really looking at it very carefully. When they invoke it, they invoke it in order to make the following, in order to advance the following stylized facts. My dissertation advisor having told me that for an economic historian, those two words are constitute an oxymoron, stylized facts. Number one, the pound sterling was the dominant and essentially the only true global currency in the 19th century, and right up to 1945, through World War II, and even for a brief period thereafter. This, despite the fact that the United States had already overtaken Great Britain as the world's largest economy around 1870, as the world's largest exporter around 1914, and as the world's largest foreign investor by 1920. And then the dollar supposedly took over the mantle as the dominant international currency only after 1945, only as a result of the shock of World War II, and it has remained such ever since. So I want to suggest that this historical wisdom is wrong. Making that suggestion requires doing a little bit of historical homework in order to try to establish how long the shadow of history, in fact, is. So this kind of empirical work requires one actually to go back to the archives, which is what we have done. I'm talking about myself and a series of collaborators, and that historical evidence suggests that the conventional wisdom is wrong in each and every respect. So the conventional wisdom is wrong about the composition of international reserves before 1945. Why did no one know this? Because no one went through the admittedly hard work to find out what the facts were. So over a period of some years, I won't tell you how many, we politicked with archivists in central banks in particular, who were loath to reveal this highly sensitive 80-year-old financial information, except when the governors of the relevant central banks, at our behest, picked up the phone and called up the archivist, who then did finally reveal the information. So red here is the dollar, blue is the pound sterling, the year is 1929, and you can see that already by the end of the 1920s, the dollar had become more important than the pound sterling as the form in which central banks held their international reserves. The crossover point turns out to be about 1923, 1924. You can look at trade finance, the instrument that exporters and importers used to obtain credit for to finance their international transactions, had the name trade acceptances. You can compare their importance in New York and in London in the 1920s, and again, you see the same thing, that the dollar had in this case modestly, it's the solid line here, overtaken the pound sterling in the 1920s. The dollar had not been used to finance imports and exports at all before 1914, not even the imports and exports of the United States, because U.S. banks were prohibited before the Federal Reserve Act in 1914 from going abroad. They had no foreign contacts. When a U.S. coffee merchant wanted to import coffee beans from Brazil, he asked his bank to go to his New York bank's correspondent bank in London to get the trade credit to pay the Brazilian coffee bean exporter, who then shipped the beans to the U.S. This changed very rapidly with the creation of the Federal Reserve Act, the creation of a market and trade acceptances in New York in the 1920s. And again, the same thing is true of the dollar and the pound sterling as vehicles for foreign investment. So Here we look at the currency of denomination of foreign bonds, bonds issued by governments on foreign markets to try to sell them to foreign investors during and after World War I. And you can see that very quickly after World War I, the dollar, the red line, leaps up to the point where the dollar is as important as the pound sterling as a currency of denomination as a vehicle for foreign investment. So what have we learned? The three dimensions of international currency experience all point in the same direction. Number one, international currency status can be gained very quickly. It was gained by the dollar from a standing start where it wasn't used internationally at all in a period of 10 years. It can also be lost very quickly, as we see from the experience of the pound sterling. Again, that's contrary to the conventional wisdom, which says use of the dollar is pretty much locked in, and international use of the dollar is pretty much locked in, and the United States can take it for granted. Number two, multiple international currencies can coexist. They did coexist after World War I, and if you look a little bit more carefully at the data for the period before World War I, you find that while the pound sterling was the leading international currency, it wasn't the only one. If you look at the currency composition of the reserves held by central banks, for example, about half of them were in British pounds, but a quarter of them were in French francs, and a quarter of them were in German marks. So it's the same picture of multiple international currencies. The second half of the 20th century, when the dollar was so dominant, when only the United States had liquid financial markets open to the rest of the world, and therefore when the dollar was the only true international currency, the second half of the 20th century is the aberrant, exceptional period, not the prototype of what we should expect. So what does this imply? Seems to me it implies that the dollar could potentially lose its international currency status quite quickly if the United States doesn't get its act together. And I will try to be a little bit more precise about that technical economic term, getting its act together, means. And even if it does, there's good reason to think that eventually the dollar will nonetheless, that it will still have to share the international stage. So I've given you the conventional wisdom about dollar dominance, past, present, and future, but there is also talk about the end of dollar dominance. People have been arguing that the dollar as the leading international currency is, in some sense, on its last legs, that the era of dollar hegemony is drawing to a close. On what grounds do they argue this? I think essentially 4 or 5. Number one, because the United States is no longer so dominant economically. Using dollars in Italy, in Japan, all over the world made perfect sense after World War II, when the United States accounted for half of the industrial production and trade of the free world. It makes considerably less sense today when the U.S. is only, depending on how you measure it, 20% or so of the global economy. Secondly, the United States no longer possesses a financial monopoly. As I asserted a moment ago, for nearly half a century after World War II, the United States was the only country with deep and liquid financial markets, freely open to international investors. It made perfect sense that they would come to New York for credit and they would finance their international transactions using dollars. This really only changed in Europe and Japan at the end of the 1980s and beginning of the 1990s, when Europe, for example, finally removed its residual capital controls. But now we have a variety of economies with increasingly deep, increasingly liquid financial markets open to international investors. The U.S. no longer possesses a financial monopoly from this point of view. Number 3, because the network effects to which I alluded briefly before are weaker than they were in the past. Once upon a time, it made perfect sense for everyone to use dollars because everybody else used dollars. You priced your exports in dollars because everybody else priced their exports in dollars, because doing otherwise made it hard for customers to compare the price of your product with the prices of the competition. It made it harder for aspiring exporters to break into new markets. There was room for only one standard measure of value, measure of prices in international markets, and that standard was the dollar, which is what gave the dollar its first mover advantage and tended to lock in its use over time. As I hinted before, until recently we heard exactly the same argument, for example, operating systems for consumer electronics. You had to use Windows because all the other students you knew or all the other professors on your corridor used Windows, and doing anything else created compatibility problems. It made it hard to exchange data and work efficiently. So Windows was the first mover. Windows got locked in. Windows would be the only operating system available to us because of these network effects forever. So we know that's not true anymore of the market for consumer electronics, that those guys have learned over time how to build open standards, open systems and reduce interchangeability costs. And I think the same is increasingly true in financial markets. Once upon a time, it was hard to compare prices denominated in international currencies. You had to go down and buy La Stampa in order to find out what that price had been yesterday, or you had to call your broker to get a guess of what it was today. Now, of course, everybody carries in their pocket a device called a smartphone with which you can compare currency values in real time. So this idea that you have to use the same unit in your international transactions that everybody else uses, I think, no longer holds water. Fourth, and most importantly in my view, because U.S. fiscal capacity is less. The global economy needs a supply of safe assets to be held as reserves by central banks and international investors, something that the International Monetary Fund emphasized in this report last month. We call that liquidity, and global markets need liquidity. For many years, that liquidity, those safe assets, have taken the form of U.S. Treasury bonds. The market in U.S. Treasury bonds is the single largest financial market in the world. It is standardized. It is unsurpassed in liquidity. It is backstopped by the Fed. It's backed by the full faith and credit of the U.S. government, such as that is. But as the world economy expands, our ability to provide the ability of the United States to provide these safe and liquid assets on the scale required by an expanding global economy becomes less and less, and the U.S. Treasury's capacity to backstop an adequate supply of these safe assets is cast into doubt. There will have to be other sources. The question is what they will be. And finally, because the U.S. economy faces significant challenges, the first challenge is whether we can continue to grow. So yesterday we learned that the U.S. economy grew by only revised figures 1.9% in the first quarter of 2012, and we know it is not going to do as well for the remainder of the year. A lot of that earlier growth was inventory restocking, which is over. Levels of household indebtedness are still high. Graph on the right, they've come down a little bit relative to disposable income, but not much. So firms are not going to be building inventories. It's arguable that consumers will not be spending. Where will the growth come from? It will not come from the public sector, because public sector stimulus will be withdrawn from the U.S. economy going forward rather than being added. The question is how dramatically it will be withdrawn. Will there be the so-called fiscal cliff at the end of the year when the Bush tax cuts expire, the payroll tax cut expires, the extension of unemployment insurance benefits expire, the so-called sequester is applied where public spending declines as well, all that could be a very large decline in public sector spending at a time when the private sector is still being very cautious. It makes me worry about 2013. So I'm worried about 2013. I would rather see the government smooth that adjustment over a period of years. I'm not totally in denial about the medium-term fiscal challenges that the United States faces. Indeed, looking forward some years, I'm quite worried about them. There's no political consensus on the United States about how to meet them, and no willingness to compromise. Everybody in the United States understands perfectly well what needs to be done to solve the fiscal problem. It's very simple. The answer has three elements. We need expenditure restraint, we need more revenues, and we need to deal with what may be going forward the explosive growth of healthcare costs. But there's no consensus about in what proportions, to what extent the solution should come from those three sources. So when I'm in the U.S., I feel compelled to show this picture. I suppose I don't have to show it here. Part of the solution in the United States, we're actually having this discussion very actively at the moment in California, where there will be a ballot proposition about raising taxes. Part of the solution in the United States will have to be more revenues. We raise less public sector revenue, this is all levels of government, than any other civilized country, aside perhaps from Australia. We're going to have to deal with that problem as well. So lots of challenges in the United States. I think all that said, and despite the country's problems, the dollar remains, for the moment, the only true global currency. But the point I made before about how this cannot remain the case forever, I think still stands. The United States does not have the capacity to pump out safe assets on the scale required by an expanding global economy. The rest of the world will grow more quickly than the U.S. Emerging markets will continue to emerge. The process of convergence of successful low-income countries toward our higher income standards will continue. So there will have to be alternative sources of safe assets, bringing me now to the question of what alternatives. So the book that Stefano alluded to went off to the publisher like a year and a half ago, 2 years ago, and I have a little bit of writer's remorse here. Like many people, I would have been a little bit more cautious about the euro had I known then what I know now. But I'm prepared more or less to stick by my guns here. I think Europe's challenge is really very simple. It's all about the banks. I was happy to hear Mario Draghi yesterday say it's all about the banks. I was happy to hear Mr. Amundsen from the German Finance Ministry yesterday say it's all about the banks. I think Ignacio Bisco said it's all about the banks, and it is. Europe, it's the solution to the euro crisis is really very simple. There is a vicious spiral connecting sovereign debt problems with banking problems in Europe, where they feed on one another in a destructive way. That vicious spiral has to be stopped or broken. And there is a second vicious spiral between the contracting economy in Europe and the banking crisis, where the two elements feed on one another again, and that vicious spiral has to be broken also. So I think this audience will be familiar with these two problems. The sovereign debt banking crisis vicious spiral is that banks, because they have their arms twisted in various ways, load up on sovereign debt. Then there are sovereign debt problems resulting in credit downgrades that lead to losses, not all immediately realized for the banks. But then somebody has to come along and fill the hole in the bank's balance sheet, recapitalize them. That, in the end, can only be governments, and that in turn worsens the outlook for government debt, which worsens the condition of the banks, which worsens the condition of the government finances without end, unless something is done to break this vicious spiral. The ECB, some people would said, tried to break this vicious spiral starting in December with its LTRO, with its liquidity operations. But all those did were to buy some time for another solution to be found, as we now realize. And they had the perverse effect of letting the banks get some liquidity from the ECB and use it to load up on high-yielding debt of their own governments. So that only reinforced the first problem that I described to you before. The second vicious spiral is again, I think, obvious to economists. That's the one connecting recession with banking problems. Recession makes for more non-performing loans. It makes for more defaults on construction projects and residential mortgages. Bad loans weaken bank balance sheets, which makes the banks more reluctant to lend. But as they become reluctant to lend, the problem of recession grows deeper, creating more losses for the banks, again, in a vicious interaction without end. And this one has operated powerfully in Europe, especially in the last year. As the bank's balance sheets are weak, the banks stop lending. This used to be called deleveraging, a term which some people put a positive spin on. Now it's called credit crunch, because people appreciate the impact on the economy. And the problem of credit crunch has been aggravated by some rather perverse responses on the part of policymakers who have, for example, sought to encourage the banks to raise their, improve their capitalization, improve their own reserves by selling assets, which only makes the problem for the real economy even worse. So people are worried. We now don't yet have the bank run problem in Europe, but as we learned again in Spain yesterday, we have the bank trot problem, where the speed at which people are removing their deposits from the banks in many southern European countries has increased from the bank walk to the bank jog to the bank trot, and you know what comes. Those who, the bank canter problem, people who do horseback riding in their spare time know what comes next. The banks can only fund themselves, get the funds they need to operate by turning to their national central banks, which turn to the European Central Bank, giving rise to this Target 2 problem that everybody talks about. So that's the euro crisis in a nutshell. And if you agree with that diagnosis, I think the implication for policy follows directly. Bank recapitalization done right is the single most important thing Europe can do to halt the operation of these vicious spirals and stabilize its finances and its economy. That will require transparency about what the situation in the banks is. Too bad, I note parenthetically, that last week the Spanish government decided not to hire BlackRock to audit the Spanish banks, because BlackRock is well known to be pretty firm about these things. Recapitalizing the banks right will require real money, not just 4 billion euros or 13 billion euros or now 19 billion euros for Bankia, but more. It will require not just 60 billion euros for the Spanish banking system, not just 75 billion euros for the Spanish banking system, but more. And the Spanish government, to focus on the case du jour, doesn't have the fiscal resources to do this. Turning to the IMF to get them doesn't help, because that just increases the debt of the Spanish government. The IMF has to be repaid, and subordinates the Spanish government's other creditors. So the money will have to come from the European Stability Mechanism. It will have to be an obligation joint and several of the European Union as a whole, read Germany, and I think that ultimately will happen. So there are a lot of things this brief discussion of the crisis in the euro hasn't talked about. It hasn't talked about the problem of fiscal consolidation. Hasn't worked. The more consolidation you've done, the worse your economic performance. I could talk about that more, but it's pretty clear here. There hasn't been much rebalancing within the eurozone. You don't have to be a PhD economist to know that if Southern Europe is going to export more, somebody else has to import more. Northern Europe, if Southern Europe is going to spend more, Southern Europe is going to spend less. Somebody else has to spend more. Read Northern Europe. There is a little bit of that adjustment beginning now, but like everything else, aside from the incipient bank run, like everything else in Europe, the adjustment is painfully slow. So economists know what to do about these other aspects as well. Northern European countries with fiscal space should use it. Southern European countries, not only Spain but others, should be given more time to do the fiscal consolidation that needs to be done. Less front-loaded austerity when the economy is weak, wedded together with more back-loaded austerity when the economy can support it. A little bit of additional European Investment Bank spending for infrastructure projects wouldn't be a bad thing, but it's purely cosmetic on the scale currently being discussed. And until those other measures are put in place, which will require time, the European Central Bank is going to have to provide more support for economic growth. There's that little problem of Greece after June 17th, which I haven't mentioned, but I think keeping Greece in the Eurozone is desirable. We can talk about that, but it will only happen with a very different approach to the Greek problem than has been seen to date. Carrots rather than sticks for the Greek people who've done a tremendous amount of adjustment given where they started from, and more aid for Greece, not more debt for Greece, which is the only thing that the Troika has provided so far. So we're hearing rumors to this effect now, but the problem is that I think of the euro crisis as a car on a racetrack, on an icy racetrack, whose two wheels are spinning at different speeds. So the crisis wheel spins very fast, and the policy response wheel spins slowly, and we know what happens to the stability of a car when the two drive wheels spin at different speeds. That's where Europe is at the moment. So I do think the ECB hasn't done enough. That's what this slide, which I don't have time for, says. I do think the ECB will do more rather sooner than later through a variety of mechanisms, both directly and indirectly. If the European Stability Mechanism, the bailout fund that comes into full operation on July 1st, gets a banking license, and the ECB can lend to it, as will almost certainly happen as well. So my worry is that whatever the outcome of the election in Greece on June 17th is, it will not be the last election in Greece. Nothing will be changed by the June election. Nothing will be changed if New Democracy and its left-center party get a working majority for the moment. The recession will deepen, unemployment will rise further if nothing else is done, if Europe sticks to Plan A, and there will be another dissolution of the government and another election and more support for extremist parties in this even more dreadful economic environment. So I would submit that a Plan B is needed not only at the European level, but in terms of Europe's approach to Greece. I'm cautiously optimistic. I continue to hope against hope that this will happen. The big fact working against political extremism you know this in Italy as elsewhere, is there's much more generous support for the unemployed now than there was, say, in the 1930s. Governments and societies now will be reluctant to jeopardize the European project when the gold standard collapsed in the 1930s. That's the analogy everybody uses in this context. There was no equivalent. Globalization had already collapsed. Tariff barriers had already been thrown up, so there was no equivalent of the European project to, or the single market to jeopardize. So all that makes me hope that Europe still has a chance of holding its monetary project together, and that the euro will not ultimately go the way of the gold standard. Longer term institutional reform, fiscal union, euro bonds, all that, I think they will come. This halfway house is not feasible. It's an engine for instability. Europe will either have to go backward or go forward. Everybody understands that now. And I continue to hope against hope. I continue to bet by making presentations like this one that ultimately it will go forward. But fiscal union and Eurobonds are a multi-year project. Europe is not going to get there tomorrow. The one thing it can do between today and tomorrow is banking union. It can give the European Banking Authority, which already exists, real authority over national regulators. It can create a common deposit insurance fund funded by contributions by banks across Europe. It can have a single resolution procedure for the big 33 banks in Europe. There are some delicate issues here, like a lot of those big banks are British. Is the UK going to be in the banking union or out of the banking union, like it's out of the monetary union? And where exactly will the funding come from, and in what proportions? I think we'll find out the answers to those questions, not in a period of years, but in a period of weeks. Let me finally talk for a few minutes about the third runner in this competition, the Chinese yuan. Here the story is somewhat happier, although it's not quite as happy this week as it was last week or the week before. The yuan is not used for international transactions very much yet, but the Chinese are intent on changing that. They understand that American banks and firms have an advantage in being able to do cross-border business using dollars. And they want Chinese banks and firms to have the same competitive advantage. Moreover, they see internationalizing the yuan as a strategy for freeing China from its own dependence on the dollar. Chinese officials, the ones I talk to, are convinced that China will have that Asia will have a single currency, just like Europe has a single currency. But in Asia, the single currency will be the yuan. And they have a careful sequence strategy for achieving that. First, encourage wider use of the yuan for trade-related transactions. They're doing that big time. Second, cautiously use its wider use for private financial transactions. They're beginning to do that. Third, and finally, encourage central banks to use it more broadly, and that's beginning to happen as well. But there are obvious challenges here facing the Chinese as they seek to elevate their currency to international status. China has underdeveloped financial markets. Its bond markets are only about 1/10 as big as those of the United States. Its financial markets are not liquid. Many of those bonds are held to maturity by banks and credit cooperatives in China itself. Bank deposits are unattractive because the banks are basically an arm of government, so foreigners are reluctant to hold deposits onshore. Financial liberalization may lead to capital outflows, capital flight from China rather than flows into China. That appears to be happening right now to a greater extent than seen previously, as people worry about an abrupt slowdown of the Chinese economy. And people are worried about the security of their foreign investments. There has never been a true international currency except one that has been issued by a democratic state. The United States, Great Britain, the Republic of the Netherlands. Before that, China would be the first. And the fact that it's not a democracy makes certain foreign investors wonder about whether the checks and balances that make a currency attractive as a vehicle and a store of value would apply in the Chinese case. So I have some stuff here that we can come back to. Maybe I'll skip in the interest of time. Is Chinese slowdown coming? Yes. Is it likely to be abrupt? No. But nobody from the outside really knows for certain how abrupt it's going to be. So how do I view the exchange rate picture overall? I think the preceding suggests that the dollar will probably remain a strong performer for the balance of 2012. The kind of phrase people use nowadays is it's the least unattractive contestant at the beauty pageant. It's the least dirty shirt in the pile. The euro will be weak because the European Central Bank will be catching up to the Fed and its zero interest rates. The Chinese yuan will probably be weak as well if the Chinese economy continues to weaken and the Chinese authorities use the exchange rate to try to boost their exports. So this is the last question I want to ask before opening things up. What happens if Europe fails to draw a line under its crisis and the euro doesn't step up to international currency status? What happens if the Chinese are not successful at internationalizing their currency over the course of the last decade? The world will have no choice then but to continue to rely on dollars for international liquidity, as a result of which international liquidity will grow scarce. And indeed, in the worst of all worlds, where investors lose confidence in the dollar before alternatives have time to emerge, international liquidity will grow very scarce indeed. What happens then? Trade credit will become hard to obtain. Cross-border lending and borrowing will become more costly and difficult. Central banks unable to find an attractive form in which to hold their reserves would tighten controls on cross-border transactions because they won't have the reserves with which to intervene in markets when markets do unexpected things. In other words, 21st century globalization would be placed at risk, I think at considerable cost to the younger generation in this room. That is exactly what happened in the 1930s. In the 1930s, there were two international currencies, as I've described, the pound sterling and the dollar. In 1931, there was first a sterling crisis and then a dollar crisis. By the end of that year, central banks had liquidated more than half of their foreign exchange reserves. They all attempted to flee into gold, but there was only so much gold to go around. They raised interest rates in a desperate effort to attract it in a period when the global economy was weak and higher interest rates were the last thing it needed. So the result was a deflationary crisis. International lending collapsed. International trade collapsed. The first era of globalization, which ended on approximately September 21st, 1931, came to an abrupt close. And the result was deflation and financial distress, the things that made the Great Depression so great. So I conclude that this is a scenario to be avoided at all costs. Much better would be a scenario in which the dollar remains a trusted and reliable source of liquidity, until which time, maybe 10 years from now, as alternatives emerge. After all, that's how long it took for an alternative to emerge after 1914. The dollar ascended to international currency status in about 10 years thereafter. This will require the United States to keep its fiscal and financial house in reasonable order. In the meantime, that may happen or not after the 2012 election. So on that vaguely hopeful note, let me conclude. I'm happy to take questions and comments.
Come avete sentito, c'è ampio materiale per...
Well, we have received a lot of food for thought. indeed, the fears about the future, some of them are new for me also, and will ponder on them. I would like to help you to understand better. The speaker said that what has happened so far denies the doctrine of expansion of fiscal consolidation, i.e. that with rapid cuts of public expenditure that would boost the growth of the economy without restricting it. This is an important statement. Some important supporters of the expansion and fiscal contraction theory are Italians like Professor Ialesina and Perotti. They are Italians, but they teach abroad, and Giavazzi also, yes. They write for the Corriere della Sera newspaper together with Alesina. Another additional note, you might have noted that while speaking of the American situation, the speaker spoke of fiscal drag. The real meaning of this term in English is different from the one we give it in Italian. Unfortunately, journalists more than economists speak as fiscal drag in English. We use it in Italian. As a matter of fact, it is bracket creep, which is much more limited. Are there any questions? Thank you. I want to break the ice. Congratulations for your brilliant paper, in particular as far as the role of history is concerned. Indeed, we learn from history that things change and that many things happen over time. My question is this. I apologize for I speak Italian. This is the Galilei language and Leonardo language, and I like these people who were really far-sighted. My question is this. It's about the euro. Do you think that euro is a real currency, or is it just the indicator of the monetary mass? So without bonds, is euro a currency, or is it a simple indicator? I tend to think that euro is not a currency, it's just a crude indicator of monetary mass. Often so Germans lose wars. So if we don't change, we will also lose the euro. Thank you.
Posso? Gruppiamo due o tre domande, diciamo tre domande.
I propose that we collect 2 or 3 questions. Thank you very much. That was really a very interesting presentation. I'd like to raise a problem about which I read in newspapers, but just between the lines. Is there a strategy in the US to explicitly weaken the euro, or an attempt to eliminate the euro? And if the answer is yes, who are the actors and what are they doing to that end? We have another question and then we'll answer them. The lady is not using the microphone, sorry. Sorry, but this lady is not using the microphone. She's speaking English anyway.
And there's now the risk of democracy, which we can see in China. So what we may expect in the future about India? Thank you.
The first of the 3 questions was about whether the euro is actually a currency or not. If you adopt the economist's approach to thinking about what a money is, it's a unit of account, it's a means of conducting international transactions, and it's a store of value, then yes, the euro is a currency, properly defined. That's different from saying it's a viable currency. One can then go on and have a debate about whether you can have a monetary union without a fiscal union, whether you can have a monetary union without a banking union, and whether you can have a monetary union without a political union. in all those respects, I think the euro in its first 10 years was unique and more or less historically unprecedented, that those things have tended to go together over time. And that's why I think Europe will have to move in that direction in order to cement the euro's status. The second question was about whether there's a international conspiracy afoot to centered in the United States in particular to bring down the euro. There's another prominent speaker at this festival tomorrow at 3 o'clock, I believe, who may be better positioned to speak about what his colleagues in financial markets are doing in the moment than I. But I can report that there is certainly nothing in U.S. government circles that is hoped for more than the survival of the euro at the moment. There, I think, is an understanding that Greek exit and the repercussions that would flow from that, and a more generalized euro crisis would be a big shock to global financial markets, much bigger than the Lehman Brothers shock. And that's not something that any responsible American politician wants. Now, I slipped a word in there, which is responsible, and we also have other politicians, I think, in the United States. But, certainly in this presidential election year, the Obama administration, which is, in control of the U.S. Treasury, where the relevant financial policies are made, understands that its re-election prospects hinge on the strength of the American economy, and that the strength of the American economy will depend heavily on what happens in Europe in the next 6 months. So I'm sure all the aforementioned people inside the Beltway are hoping that Europe draws a line under its crisis, and if anything, voicing some impatience about about the steps that have been taken here already. So the third question, I only got the last part, which went into the microphone, but I think it was a question about this long-standing comparison between India and China, that they have different political systems. What does this imply for their economic prospects? I think in the short run we're seeing again that, and for their currencies. I do think that it is important to international investors, both foreign central banks and private investors, to understand that the country in which they're placing their investments, their savings, is governed by rule of law, that there is a certain level of transparency about bank regulation, about financial markets, etc. And there are some doubts about the Chinese political system on those grounds. Democracy, on the other hand, is no guarantee that potential problems of corruption that are also of great concern to investors can be dealt with. So I don't think either strong autocratic government or democracy are magic bullets from this point of view. It all depends on how you do it. And we don't know whether, what is shaping up right now to be an economic crisis in India is going to be the clarion call they need to deal with their corruption and red tape problems. We don't know how current political events in China, which are moving very fast, are going to develop over time. Those questions are above my pay grade.
Sì, ci sono altre domande. Prima un piccolo chiarimento.
The point of clarification, many are listening without translation. Inside the Beltway, in America, it means in Washington, at the government.
It's always thought-provoking to listen to you. Given the fact that you mention one of the person who will be speaking tomorrow at 3, I think it's quite interesting that he's mentioning a Tommaso Padoa-Schioppa plan for Europe in his latest book. I mean, but I don't want to apply reflexivity to conspiracy theory. I mean, so I move on to my question. And my question relates to your presentation. At a certain point, you said it's all about the banks. And then you discuss about the European Central Bank. Now, can I ask you a specific thought on central banks in particular? We saw in the last year quite a shift in the Italian Central Bank. They moved from Draghi as a governor, looking and criticizing and advising the government, to Visco, which is more looking into vigilance and letting the European level acting politically, so to speak, and in terms of policy making. So I was wondering, what are your thoughts on central banking and methodologically about politics? Because it's a lot about politics, and I wonder how those economists look at politics, I mean, into these circumstances. Thanks a lot.
Sì, buongiorno. Due domande.
I have two very quick questions. Do you think that the weakening of the dollar started in the 70s when the gold standard was abandoned? Second question, as this is election year, do you think that would be a quantitative easing?
For wage inflation and higher internal demand in Germany and policy action like that are a feasible solution for the euro area and to a feasible solution to offset what Olivier Blanchard called the rotating slumps mechanism, which is enforced nowadays in euro. And on the other hand, what do you consider the first and the most important feature of an optimum currency area that the euro area needs nowadays? Thank you.
So I think, excuse me, I think the most important missing element in the architecture of the euro area is banking union. And it's interesting to step back and ask why it's missing. If you look back at the academic literature, analytical literature on monetary unions, on optimum currency areas, they talk about things like asymmetric business cycle disturbances, labor mobility, fiscal federalism. They don't talk about banking union. And that was a failure on our part to an extent. I think it reflects the fact that banking systems were still very heavily segmented along national lines. Financial liberalization and cross-border banking had hardly gotten underway in the 1960s and 1970s when the early literature developed. And when we all started writing about this again in the 1990s, we drew on that earlier literature, which overlooked the importance of having a banking union to go along with the monetary union. I did write an article in 1993, which gets quoted now, where I talked about the need for banking union, but we as a profession did not really appreciate the importance of that. You asked also about the rotating slumps problem and about whether fiscal stimulus and more spending in Germany and Northern Europe is a necessary part of the solution to Europe's problems. And yes, I think it is. The difficulty of talking about the euro crisis is, of course, it is not a crisis. It is multiple crises. There's the banking crisis, there's the growth crisis, and there's the crisis of internal imbalances within Europe. So that problem of rebalancing Europe, of Northern Europe spending more as Southern Europe spends less, of Northern Europe importing more as Southern Europe exports more. There has to be adjustment on both sides. The European Commission came out, what was it, on Wednesday, with its reports on the euro area economy. It missed this point again, yet again, for the 14th time in the last 3 years. by not talking about how these economies are part of a larger European economy, and the adjustment has to be on both sides. In principle, it will come in Germany and the rest of Northern Europe in the form of higher incomes, 5% wage increases for the German metal workers and others, and they will spend more. The process could be accelerated by some useful fiscal stimulus. Quietly, German leaders, I think, are making all the right noises now about how they see the need for those adjustments, and even for higher inflation in Germany than would have been acceptable in the past. The problem is that they've gone so far out in the other direction, convincing their constituents that all these are undesirable ideas and they would never go for them. It's going to be difficult to change directions now quickly. So there was you have, Stefano, do you remember the other two? There was one about central banking, and in the middle there was one.
Yes, about central.
But there
about the change in attitudes by the Italian central bank from Draghi to Fiscal.
Yeah, so I'm going to pass on that one. I don't know enough about Italian monetary politics to say anything useful there. I do think that central banks around the world are under political duress, political attack, because their actions have so exceeded their traditional mandates, where they would focus on price stability. Then it became apparent they had to focus on price stability and economic stability and financial stability and other things as well. I think we live in a world where central bankers are the only adults in the room, and they have to behave like it. Other policy is on hold. The other adjustments we would like to see are not being done, so central banks have become the policymakers of last resort, and that they are doing more than their mandates traditionally authorized them to do means that they are now the targets of rather vicious political criticism. I think that will remain the case and be unavoidable until the other policymakers resume acting like adults.
Mi piacerebbe sentire una voce femminile. C'è qualche signora che vuole parlare?
Is there any lady who would like to intervene? We have another question here.
Professore, io volevo chiederle.
Professor Eichengreen, what's your opinion about the proposal made by a number of people and that is largely supported in some emerging economies like Russia, China, India, to create a group, a basket of the main currencies, the Russian, Chinese, Japanese currencies and so on, that could be used as a virtual currency for international transactions. So it wouldn't really be a real currency like, the euro, the dollar, or any other, but really a basket of currencies, something that should be used only for international transactions, and which allegedly should limit the changes in interest rates. Now, do you believe that this is something that could actually be done in the next years, and would that be the right choice?
Hello. Actually, I'm from Germany, so maybe it might be interesting to see a German view as well. Only last week I've been attending a discussion among economists from Germany, and it's been quite interesting to see that from different sides of the aisle, so to say, they agree that Germany production must be more expensive than it's been in the past, because the divergence between, let's say, Greece and Germany is too big, and Greece can't tackle it alone. But when I'm talking to German companies, they completely disagree with this finding, and because they say we are not in competition with Greece or Spain at first, but with China and Asian countries, and this is what happened in the Schroeder years with the Agenda 2010, that we have to be able to compete with China and Chinese productivity. And so if we start now increasing our production prices by paying higher loans, we won't be able to compete with those countries again. So what would you answer, or what would you suggest for German companies? Well, apparently they have to pay something for it, but what is more expensive? Not being able to compete with China anymore, or not, or losing the euro maybe? Thank you.
Hi, it's a pleasure for me to hear you directly after hearing the McAlvany Fund interviews, which I had you some time ago. Anyway, the question is, I'm glad you introduced the trading balances. So it's not all about banks. Of course, a bank run is about banks, but the problem is not just banks. How we dealt with the Lehman bankruptcy is still a mess today. But the only lesson we got out of there is, I see just more bailouts and more can kicking, and this cannot go on forever. Is anyone working on bank crisis, bankruptcies laws, and even more on international bankruptcies? Because if probably we don't work about that, then there is no choice from banks other than restrict to their own countries and to their own governments.
Chiedo scusa agli
I apologize to the experts of finance because my question is going to be very naive. It concerns currencies. Originally, of course, there was gold that were then followed by banknotes supported by the gold, and then the gold reserve system disappeared, and so after gold there was the dollar, and after the dollar there's nothing else. So my question is, I know it's a naive question, but how can the man in the street be sure that what they have in their hands are real banknotes and not just waste paper?
The last question was great, and probably the only answer I can give is nothing is sure in life. And if you had decided that gold was a better thing to hold rather than currency notes 3 or 4 months ago, you would be very unhappy today. That's not by no means a sure bet either. But the money issued by national governments, or in Europe's case, by collections of national governments, is backed by the full faith and credit of those governments, and those governments are answerable to you. So that's another way of saying nothing is sure in life. On the banking issues, I share your concern that too little has been done. So your question was, is anything being done about these problems of our inability to resolve, to close down when they are insolvent large cross-border banks, and more generally deal with their problems? The answer is much is being attempted. So the Financial Stability Forum, another entity that Mario Draghi used to run, the Bank for International Settlements is trying to do this on create committees of regulators at the international level to deal with these problems and encourage the adoption of common standards for bank resolution and the like. At the national level, we have made some very modest progress, I think, in that direction. In the United States with Dodd-Frank, very modest indeed. Some countries like the United Kingdom think that because these problems are so intractable, we need to force feed more capital to the banks so that they are less likely to get into financial problems, given the difficulty we have in resolving them. And here's a radical idea for you. If big banks are so hard to resolve, we should have fewer big banks. But that, the problem with that one is the political one. So remind me, there was one on Germany, and there was one on a basket of currencies. So yeah, I understand the reservations of German firms, of German producers, that higher costs mean less export competitiveness, and I think the answers to that are two. Number one, what's in the interest of an individual German firm may not be in the interest of the country as a whole, and vice versa. And number two, if export competitiveness is a valid concern, then there are other instruments that can be used to encourage more spending by German consumers, like fiscal policy. What you described sounded to me like another strong argument for a bit of fiscal stimulus in Germany. And finally, the idea of a synthetic currency unit made up of a basket of currencies. Until recently, people were talking about a basket of the currencies of the leading countries, whether they were an emerging market like China or an emerged market like the United States. We have a version of that called the IMF's special drawing rights, which is, purely electronic, purely a bookkeeping instrument. Will it work as a replacement for the dollar, or for the dollar and the euro and the yuan on the international stage? No, it will not work. I think the Chinese, who were playing with the idea, have backed away from it in the last couple of years. They understand that the problems of governance and management are the problems the euro faces, squared. So an international currency would not only be used for settling trade-related transactions, it would be a source of liquidity for people who needed more of it to intervene in markets at a point in time. We know from history that these different dimensions, different aspects of international currency status go together, that a currency is attractive for one use only if it's attractive for the others at the same time. Let's say that there was a liquidity crisis, and more of this global unit had to be supplied to markets over a weekend. Who would decide? Would the International Monetary Fund decide? Would you expect the Russian and the Chinese and the Indian and the Brazilian governments to decide? The problem that Europe faces, that there is a single European currency, but there is not a single European government to respond over a weekend when a problem develops, would be writ large if you thought about a serious role for a global currency, basket-based or otherwise.
Bene, ringraziamo Barry EICHENGREEN e dichiariamo chiuso questo dibattito.
Okay, thank you very much indeed. Thank you, Mr. EICHENGREEN. And I think we need now to close this session, which was definitely very interesting.